Let's talk about how you can lower your margin requirements by 50% or more instantly. And there are actually a few techniques that you can use. I sometimes use one of them, two of them at a time. It really depends on the situation. But basically, the easiest way is probably to buy cheap far of the money calls or puts, depending on your position, with less days to expiration than your current position. And we will go over an example in just a second. The second thing is you can be buying or selling the future contract or one future contract per every 5 option contracts. Now this depends. Usually I do it 1 to 5. Sometimes you can do it 1 to 4. It depends on what deltas you are looking at, because when you buy one future or you sell it, it's delta 100. And if, for example, you have 5 whatever calls, and they're each delta 20, so 5 times 20 will be 100. So you will have delta 100 on the future and delta 100 on your options. This way you can offset risk to one side at least, and as a result your margin requirements will fall down by quite a bit. The other thing you can do is you can buy longer DTE options at the money. Usually the theta is smaller with more DTE, so you can buy at the money or out of the money. This is my least favorite thing to do, because you need to make sure that overall your theta is still positive when you do it. So again, it really depends, but this is another technique which we'll go over live right now. So let's begin with buying cheap part of the money calls or puts with less DTE. So this is a demo account. So this is a current position, and the margin maintenance currently is 31,500 for this position, and we have 16 contracts on soybeans, and this is 66 days to expiration. So if we go to the option tab and we look at the 66 days, so if you want to buy cheap calls and puts which are out of the money with less DTE, I will go with 38 days to expiration. So, and because I have a strangle, I'm probably going to be buying a strangle as well on both sides. So let's see what we can get if we just go 930 and 1140. And again, there's no exact math here. You're just gonna need to play around with it and see what kind of debit you're gonna end up paying for it, because we also received about $16,000 in credit for the position. So let's see how much we will be paying per one contract. So the max loss is $113. So this is basically how much we are going to be paying for one contract. So see what if we go 8 contracts. So 8 contracts will reduce our margin requirement by $13,000, and it will cost you about $900. Now we received, like I said, $16,000 in credit, so it's not bad at all. But at the same time, see if we can go a bit higher. Yeah, if you go a bit higher, you can take exactly half or even a bit over half your margin, or cut it by half at least. So this is a really simple way, and you can play with the options. You can go deeper in the money or closer to the money. Usually it's all kind of almost the same thing once you go far out of the money, like we are right now. But you can easily just cut your basically your tail risk as well, at least for the next 38 days, and reduce margin by over half. So this is one thing that can be done. Now, another thing will be, like we said, buying and selling the future contract. So because it's a strangle, we will just do an example for buying it. It doesn't really matter, but if you are directional, it's gonna help a bit more. So if you go to futures, and this is the November expiration. So let's say we're gonna be buying it, and we have 16 contracts, so we'll probably end up buying 3 of these. So let's go to the advanced tab and check margin. So maintenance margin, actually the margin will go up in this case because the delta on the position is already 9, right? So let's see what happens if we just sell it. And this is the kind of thing you just have to do. You just have to play with it. So let's see, the margin will go up here as well. So let's try to maybe do 1 contract, see if it does anything else differently. No, so even one contract adds about 3,000 in margin. So from my experience, usually if the position becomes really directional, then you will be able to do it. In this case, it's not really directional, so it's pretty neutral currently, delta 9 for the position. But overall, and also depends on the countries, but most countries, if you buy or sell the future contract itself, and you have that 1 to 5 ratio, it will lower your margin also about by half or close to half. In this example, it doesn't really work out because the delta was higher when I was planning this video, so it just happened to go down right now. It's 8.3. Now the last thing you can do is obviously go to a bigger expiration. So we can go to the November expiration, and let's see here, and we can just, for example, again, this is a neutral position. Let's see, there's not much liquidity here. Here we can go to 129. There we go. So let's say we just buy a straddle. Let's see what we get. And actually before that, let's take a look. We have a theta of $184. So we need to make sure our theta is still positive. So the theta for this straddle is 129. So we are still going to be positive theta if we end up buying it. Now we don't need 10 contracts. Let's try and go for half, about 8 contracts. So it improves our theta, and at the same time we also have quite a bit of reduction in our margin requirements. Now again, this is a bit of a different thing to do because these in the money or these straddles, when the price moves, theta goes down quite quickly. So if we go and look at the 5% move, you can see, so if the price moved about 3%, theta will go down, you'll be in the money, you'll have more extrinsic value. So this is also another technique, but they do give you more protection as well as margin reduction, of course, but they give you way more protection if price moves up or down quite a lot, because their vega is much higher. So these are basically the 3 techniques. Probably the most common one will be the first one, buying cheap part of the money calls and puts. Now the second one that I would use is probably buying longer DT at the money options, because these can give you protection against big price movements. And then the last thing will probably be buying or selling the future contract. This is the absolute last resort for me, but these are the 3 things you can do to really lower your margin and obviously stay in the game. Now you don't do these things right away. I would, some people might do it to just kind of open bigger positions, but I would do it only if the position is struggling and margin is starting to inflate and I need to lower it and add protection to my position. So I would go with the at the money longer DTE if I think there might be a big move coming and I want to protect my position, my short position, and this will give you basically a positive vega expectancy. So if price moves pretty strongly up or down, you'll be making money overall. And these ones, they obviously have negative theta, or you will be net negative not theta, vega, sorry. And if there's a big price move, you're not gonna lose as much as you would without having it, but it will not give you as much protection as the at the money longer dated options. So this is it. Hopefully this video was quite useful, and let me know if you have any questions or any other requests for any videos. Thank you again, and I will catch you in the next one.